So when you talk about $3 to $10 million equity checks, typically how big are the deals themselves? What kind of leverage are you looking at? I mean, obviously that's how long is the length of string, but generally.
Anywhere from about 10 to 25 million. Sometimes on a $10 million check, you might get upwards of 30 some odd million. You will take out leverage dependent on the security of the deal. If you are stealing a multifamily asset, it's really not going to be on a loan to value ratio. It's going to be on a debt service coverage ratio. What can I cover my debt at? We are market agnostic to a degree. We like to produce in all cycles, and the way we do that is based on stabilizing to a specific cash flow. If you value your assets stabilizing to a specific cash flow, you are less worried about a loan to value constraint, but a debt service coverage ratio constraint.
Right, that's debt. In other words, you're talking about not being over leveraged in simple terms, right, basically.
Yes, or breaking it down between loan to value versus debt service coverage. Someone might ascribe your value as low. So if you have a lot of cash flow every year, and someone says, well, this asset's worth less, if you're in New York City, Los Angeles, Miami, Washington, D.C., buying at 3 caps, and all of your value is effectuated on a capital event, you're going to be in trouble. But if your value is extrapolated from cash flow and you're making 12% and somebody says that asset's worth less, well, you can sit there making 12% until it's worth more.